automation capabilities, both of which are resonating with our clients. Our large deals pipeline is seeing increased traction for automation and cost efficiency programs. Strong growth was accompanied by stable operating margins at 21.5%. This was driven by healthy revenue growth and cost optimization benefits. Our voluntary quarterly annualized attrition continues to decline. It was reduced by 6 percentage points sequentially to well below 20% for this quarter. While we are encouraged by the immense confidence and trust our clients have in us, the signs around are showing a slowing global economy. Some areas such as mortgages and investment banking in the financial services industry, telco, high-tech, and retail are more impacted, and that is leading to delays in decision-making and uncertainty in spending in these areas. We are confident that the strength of our digital and cloud capabilities and our automation capabilities will continue to position us well in this market. We're keeping a close watch on the global economy. Our operating model and offerings are agile to deliver value for our clients in this evolving macro environment. Driven by a growth of 17.8% in constant currency for the first 9 months of FY23 and the strong large deal value for Q3, we are increasing our revenue growth guidance, which was at 15 to 16%. We are increasing it to 16% to 16.5% for the full financial year. This despite the changing global conditions. We are retaining our operating margin guidance for FY23 at 21 to 22%. We anticipate to be at the lower end of this range. Thank you. With that, Rishi, let's open up for questions.
Thank you, Salil. We will open the floor for questions. Joining Salil is Mr. Nilanjan Roy, Chief Financial Officer, Infosys. With that, we have the first question from Ritu Singh from CNBC TV 18.
Hi, thank you. You said you've increased your revenue growth guidance despite changing global conditions. What gave you this confidence? Why the revision up? What about furloughs? Were they lower than what you were expecting from your comments in the last quarter? Also, we've seen a significant rupee depreciation during the quarter, and yet the margins have more or less remained flat. What is the reason for that? And any visibility you have on the FY24 growth, because you're talking about this difficult macro environment, and yet you've revised up your guidance. So what are you hearing from clients in terms of their budgets and these large deals that you say continue to be strong in the pipeline? Are you seeing more renewals or newer deals that you expect to win? And a word on attrition and hiring as well. Do you expect it to continue to trend lower? I think it's the lowest in the last 5 quarters. And also, hiring is lower than the previous quarter. Is it because you're anticipating lower growth? Any comment on that as well? Thank you.
Thanks for the questions. I'll try to get through most of them. On some of the points on margin, Nilanjan will jump in as well. On the guidance, our focus is really on what we see as we closed out the quarter. We had exceptionally strong growth, Q on Q, 2.4, year on year, 13.7. For the first 9 months, we are at 17.8%. Then we had a very strong large deals at 3.3 billion. It's the largest we've had in 8 quarters. And the number of deals is also a testament to the environment for us. At 32 deals was very strong. Given all of those factors, we saw that it was right to increase our guidance. The point we made also is we do see that there is changes in the economic environment. We've called out, for example, in financial services, beyond mortgages, investment banking. We've called out the telco sector. We've called out high-tech and retail. But keeping all that in balance, there were some things that gave us a lot of support, while we see other factors in the environment changing. But keeping all that in balance, we were ready to increase our guidance. On attrition, I think, before we go to the margin and so on attrition, we've seen a steady quarter-on-quarter decline for the last several quarters. We believe many of the policies we've put in place to make sure that we are more and more aligned to where employees are focused on is helping. And of course, the overall environment is also changing in the market. So we see attrition continuing to go down. On FY24, we have no comments at this stage. We will absolutely look at it at the end of the quarter in Q4. On hiring, we have the number of hiring based on what we saw on the demand, and we've also had a very strong hiring for the full year in FY23 and also before that. And we are making sure that all of that hiring goes through our various training and is ready for deployment.
Yeah, so on margins, we've at 21.5, and that is flat sequentially. A couple of reasons, and first, of course, you mentioned about the benefit of currency. So we got a net benefit of about 40 basis points from currency, net of our hedges. So that was one tailwind for us. We got another benefit of about 70 bips from our cost optimizations, for instance, our subcon costs, etc. And from a headwind perspective, there's about 30 basis points additional spend on our SG&A. And the balance, about 80 basis points, was traditional seasonality in the quarter, furloughs, partly because of our third-party costs. So these are the balance 80. So that's a broad walk, about a flat 21.5% margin within our guidance, as you know, of 21-22.
Thank you. The next question is from Anisha Jain from ET Now. Anisha sends us questions on text. Salil, the question for you is, there has been a strong execution and deal win in Q3 that led to the guidance upgrade as well. Can we extrapolate this to believe that the client budget will be robust and double-digit revenue growth will sustain in FY24? And could you give us a bit more insight on the trends you're witnessing in Europe and for verticals like BFSI and high-tech? And Nilanjan, for you, there's a question on margin which you just answered. A follow-on question on attrition that is coming down sharply. Could there be a sharp reversal in margins from Q4 onwards? How are the pulls and pushes stacked for margins?
Thanks, Rishi. On the first part, I think we talked a little bit about why the margin was increased. In terms of what we see in the environment, we are not commenting, obviously, on the financial year 24 and what the guidance or growth in that year will look like. What we do see in terms of demand environment is what I shared earlier. We see some areas, for example, the mortgages area or the investment banking area and financial services. We see some areas in telco and high tech and some in retail. There is more variation. We see in the European markets more concerns on what's going on with the economy. The US market is also there, but relatively less so in the US with respect to Europe. We will see how this plays out, because this is not a scenario where it's the same for every industry. For example, we've seen extremely strong growth in energy, utilities, that part of our business, and we continue to see that in Q3. We saw very strong growth in manufacturing, and we continue to see some of that traction in our business in Q3.
The question on margin was attrition.
Yeah, so absolutely. So one is, of course, as you know, if you've seen our utilization, in fact, that came as a headwind for us. We have built a large fresher pipeline. They go through our training, like Salil mentioned, into Mysore, and they're on bench. Now we are training them, reskilling them. And in fact, that will give us some headroom, in fact, for growth looking ahead. So the question partly about, do we need to hire more? So we have a very substantial bench, and I think our utilization at about 81.7 is one of the lowest we've had. So we have some headroom there. So looking ahead, of course, subcon costs, we brought them down. At one stage, we used to be closer to 7% of our revenue. We are around 8.7. Utilization, another factor. We continue to work on pricing. Of course, on-site, offshore, the pyramid itself, with the freshers coming in, will help us. So the other levers we will have to deploy as we look ahead in the next few quarters.
Thank you, Nilanjan. The next question is from Sajid Pangat from BQ Prime. Sajid has a couple of questions. For Salil, he wants to know, give us a sense of the demand environment in North America, UK, and Europe. And have you seen a trend of small deal sizes compared to what we saw in the last 2 years? Do you foresee a slowdown in deal closures? Nilanjan, your question is again on margins, which has already been answered, so I'm not asking that again.
On the demand environment, sort of similar view. I think we see different demand environment in different industries, and even within some industries, there's a variation based on the client. We're also seeing much more demand today for automation, cost efficiency, operational improvement programs. The size of the deals, as we see with 3.3 billion in large deals, we have a tremendous volume, 32 of those deals for this quarter. So we do see a change in the environment, but we see that both of our engines, the one for digital and cloud driving transformation, and the one for automation driving cost efficiency, both are working and both are growing for us.
Thank you. The next couple of questions are from Z Business, Kushal.